Welcome to Making Your Miles Count Production, an educational program to all Canadian lease owner-operators with your host, Robert Scheper.
Well, hello there, and welcome to Making Your Miles Count podcast. And today we have a wonderful couple, but we're going to be talking about the Ramsey Solutions or Ramsey Financial Peace University in Canada and its impact and different options you have if you're looking for a debt-free living. And I'd like you guys to introduce yourselves and where you're from.
Hey, we are David and Isabelle Gagné. We are in Niagara Falls, Ontario, Canada. The second most desired location to visit in the world.
Awesome. I've been there myself and my wife a couple times. We went to the top of that thing. I'm scared of heights, so I don't.
Skyline.
Yes, yeah. So it's great having you here. Could you tell us your financial story? Where were you, and how did you get to where you are today?
Sure. Well, we just celebrated our 30th anniversary this year. So at year 23, we were $137,000 in debt, consumer debt, with a hefty mortgage on top of that. And there's a much longer story, but we'll keep it condensed. We decided that we were drowning and we needed to do something. And everything that we had tried to do over the years, or rather everything Isabelle had tried to do over the years, I would mess up. So we finally got on the plan together, and we discovered the Financial Peace University through Ramsey Solutions. Did the DVDs, actually. We took the course just ourselves in our living room. We learned it, we applied it, and 18 months later, after working 7 jobs between the two of us for that period of time, it was a lot of hard work, but we dug out. We went through a consumer proposal in a process, but some of it was forgivable. There's a long story there, working with banks that don't want to work with you. So we didn't have much choice in the process, but we did what we had to. And after 18 months, we became debt-free. And within a short period after that, we sold our house and we became mortgage-free. So we have been completely debt-free since 2018.
Yes. 2018. All right. So you have I guess you would call it a program called the Money Plan. Why was it that, maybe what I'll do is, from myself, when it comes to Dave Ramsey and myself, I went through a financial crisis, I guess, about 20 years ago or so. And I found a DVD at a garage sale, Total Money Makeover, and I fell in love with the topic. And honestly, it was the first time I really understood that people can live without any debt at all. And they have to be purposeful about it and organize their life accordingly. And it was a revolution. Even though I had an MBA in financial management, there is no way in the world that contemporary education talks about debt-free living. They all talk about, smart debt, and you have to have a certain amount of leverage and stuff like this. And debt is always included in there in some form or other. And so that was always in the back of my mind. And I fell in love with the whole aspect of being debt-free. And I have listened to Dave Ramsey's program probably starting, I think it was in February 2020, just as COVID lockdowns was coming in. Up until current, I have never missed a program. I don't recommend everybody do that, because that's a lot of time. That's just brutal time. But I did it because if you listen to him you only really have to listen to him for about 6 to 9 months before you get the general gist of everything that he's teaching. But if you listen to him for longer than that, about 1 or 2% of the time, you get another nugget that you never quite thought of. Like, I was just about ready to stop listening to him. And all of a sudden, he started talking about inheritance and how to take the wealth that you have and divvy it up with your children or do different things. And the whole thought process of values in your inheritance. And that just stopped me in my tracks. And for 3 months, I had to sit and think, what? And my wife and I discussed what are we going to do and stuff like this. So it completely changed everything from our will to how we deal with our kids and grandkids and stuff like this. So there's continuous things that I'm constantly learning. And now that back in 2020, it was just Dave Ramsey show. And it must have been in 2021 that they started bringing in more and more of these, what do they call them?
Ramsey personalities.
Yeah,
they've been doing some succession planning there because Dave obviously can't go on forever.
Which is another thing that I learned because in business, I'm looking and I'm thinking, okay, what am I going to do for succession? So and great advice for all of this, all of this in there. So, but when you have individuals who are focused on like Ken Coleman with employees,
right?
And what's his name, the psychologist, or he does a lot more family oriented conflicts and stuff like this. And the different topics, you educate yourself on the different things all under the same format, everything from debt free to boundaries. And I've listened to I've done a lot of their Entree Leadership podcasts, and not just podcasts, but going to their events and stuff like this. Bought a lot of their books. From a Canadian perspective, the only thing that is a little bit not off, but you have to interpolate a little bit, is he comes from a very strong Christian background. And for the most part, the vast majority of people in Canada who are like that, who like Ramsey, it doesn't really bother them. Like, for instance, I have a lot of Sikh and Muslim and Hindu clients, and I got some Hindu people, and actually in all the faiths that love Dave Ramsey because great advice, and they're able to retain their personal faith and religion without the effect. And realistically, it's the financial wisdom that he's imposing, or not imposing, he's teaching, that is important. So it's interfaith very much more in Canada, and that's one thing that sometimes is a little bit of a hurdle in Canada, because Canadians are not as Christian as United States is. They say evangelical Christians in the United States are something like 42% of the population. In Canada, it's something like 6 or 8%, depending on whatever. So the percentage is phenomenally different. So it's a different audience for sure. But it is absolutely and completely applicable to the Canadian market as well.
Yeah.
There's one other thing. Canadians, they've been cashless for much longer than a lot of places in the States. I remember driving truck years ago. I had a debit card, and when you go down into the States, South Carolina, Georgia, those guys, they didn't even know what a debit card was.
True.
Back then. And most of Canada at the time was using debit cards and had no problem with it. So there are some, because we only have 7 banks, we're able to get technology much faster than in the state. They have 5,000 banks or 10,000 banks or something like that. We have 7. So there is a little bit of difference in some of the things that happen. But maybe what we can do, let's talk a little bit about why Financial Peace University is not accepted legally here in Canada. You tell me your experience with
Sure. I just want to back up to what you were talking about as far as the Christian view of Dave Ramsey and Ramsey Solutions and all that, because the principles are biblically based.
Yeah.
So it's not offensive to those that are non-believers or of another faith, because we do the same thing. Our course is also based on biblical principles, and we don't shy away from that. We actually pull those scriptures into our teaching and then relate it to what we're teaching, so that there's this connection for people. And we've actually, Ramsey says it as well, but we let people know, read Proverbs, it's one a day for a month, and you get yourself a degree in finance, right? By doing that. And we actually had a lady come back that wasn't attending church, not part of a church. And she says, I started reading Proverbs a day. It's like, that's awesome. You're reading God's word, and you're being equipped, and you're learning about how to be wise. So whether you're Hindu or Sikh or whatever faith, you can glean from what God's word says, because it's truth. And so we don't shy away from that whatsoever.
Actually, we credit cards cause more offense than using Proverbs in our teaching. We'll see people get all ugly when we start talking about, your credit cards are part of your problem. But we've had flat out atheists in the class, and they're like, this is good. I like that. That's really wise.
Yeah.
But don't talk about my credit card.
Yeah. So coming back to financial peace, quote unquote, university.
Yeah.
That is the problem with our Canadian government. And it's not Canadian government, it's more specifically provincial governments. So certain provinces, I know we're in Ontario, so when we looked into bringing Financial Peace University to Canada, talking with Ramsey Solutions, I was talking with one of the directors of operations and saying, why can't we have this here in Canada? It doesn't make any sense. They wouldn't sell it to us. Yeah. And so we were helping our friends with it. We were sitting in our living room, showing them the DVDs, and we wanted to take this bigger and wider. It's like, wait a minute, why can't we do this? And I remember I got a letter from the Ontario colleges and universities, and it basically said, because they are not an accredited university, they cannot claim to be a university. If they would have called themselves Financial Peace for Life or Financial Peace take the university off, we'd be talking about that. Now, we would probably have some complications as far as what Canadian versus American and the differences. So they would have had to modify that, and that was one of the discussions we had with them as well. And the discussion was, there isn't enough market for Ramsey Solutions. So that was the challenge. So certain provinces will not allow it in Canada based on that reason.
And I found that Ramsey, a couple of things. Ramsey wouldn't. I've been to their office twice, and the first time I was there, they would not sell me anything that had university in there. As soon as I told them I'm from Canada, and I go, come on, this is a really good book. Can I have no? They wouldn't even sell it to me because they knew I'd cross the border.
And that speaks to Dave's integrity and his values, because he knows that that's the agreement that they have with the province. So he's honoring that, and obviously communicating that to his staff.
It's to our shouldn't say demise, but it's to our disbenefit for sure.
Yes and no. I mean, it ended up being a positive for us, right? Because we would have continued and struggled with that, as we'll talk later, struggled with some of the terminologies that don't cross the border well. So for us, it's like anytime you come up against a wall like that, what do? You either stop or you climb over the wall and keep going. So we said, you know what, this is helping people in our circle. So how do we continue to help people? Because I think Ramsey says it himself, that him continuing to teach it is what he has to do to keep himself on
constant
track.
Therapy.
It's constant therapy. So that's what it is. In many ways for us, it keeps us accountable, because we miss doing a budget when we can kind of look at each other and go, well, we can't do that, can we? Because we teach this stuff. So now a negative turns to a positive.
Sure. When it comes down to, there's lots of people who've taken Financial Peace University in Canada, and that's primarily because you can buy it in the United States and technically smuggle it into Canada, right? So it's a little bit hilarious when it really comes down to it, because you're smuggling really good advice into Canada. By all means, nobody's going to go to jail. No, it's definitely
No, and it's good teaching. And
Yeah.
we our course, we teach the same principles. And we found as well, we were doing it in person for a season, and then pandemic happened, and it forced us to go online because we still wanted to teach people.
Yeah.
And it really broadened our view of those that we could help. So the first time we did it, we had people from coast to coast to coast, as well as an expat from Japan that joined in. And it was quite exciting to see Canadians. So our focus has changed from helping those locally to helping those all across our nation. And the online is a great tool. I know Ramsey Financial Peace University is 9 weeks, unless they've changed it. We adapted ours to be 6 weeks, simply because we find that is a doable span for most people. As soon as you say we need you to commit to 9 weeks, it's a little much, but we backed it up to 6. And we tell some of our stories, and Dave has great stories, and we realize that he has more stories, but the same amount of content. So let's just shorten the stories and get the content out there in people's hands. And we've been able to do that. And we're in a course right now. So
Tell me about the money plan. What was the inspiration, and what are the terms? And how do people sign up? That kind of thing.
Okay, well, so like I said, we were teaching financial peace, like incognito at our church and neighboring churches, and quite enjoying teaching it. But when we get to that part about investments, and you had to say IRA is RSP, and we already got too many acronyms going on, and we could see people glazing over, and all the questions were coming from that lesson. What do you mean, and how does it? And so we moved here to Niagara Falls in 2018, and we just buckled down and we said, we've got to do a Canadian version of this. We just can't keep doing that for the reasons we've talked about, and then this Canadian content stuff. So we took a couple months and we just wrote the content and taught our first one here at our own home church. And it was so much easier to get that content through, and to get the, okay. And I mean, we always encourage people to use a financial planner and an expert, because we are not experts. We are experts at our story, but not at financial advice. So we tell people, go, and the stories that keep coming back is, I now knew how to talk to a financial advisor. I now had the confidence to go to one. Oh, that's changed everything. So we didn't have those stories quite the same before when we were teaching the American version, because I think people just left just as confused as they came in. So that was a big win for starting our own version of these steps. And they are very similar, 7 steps. So one is that basic emergency fund, the baby money. Step 1 is get that $1,000 set aside. Number 2 is to get out of commercial or consumer debts. And then step 3 is to build that emergency fund to 3 to 6 months. And step 4 is save for your kids' education. To come backwards, 5 is 15%-ish into investments. 6, pay off that house early. 7 is to build wealth and become generous. So very similar. And we have a grandma in our course right now, an 82-year-old woman, and she's nodding, going, yeah, why is this new? Right?
She's there as a support for somebody. So
right. She's brought friends, and she's like, we've always done this.
And when we started teaching the money plan opposed to the FPU, one of the things that we discovered very quickly was there is power in sharing our personal story, our testimony of where we were, where we are now. So as we share that, it gives people permission to go, okay, I've messed up with money too, because most all of us have at some point in life. And the lie that people believe is that they're in their mess alone. And so that's why doing the course together with people, whether it be online or in person, but doing it together with other people, that's where we find that there's strength, because then we have dialogue with one another. We hear other people's stories, like, oh, I'm not doing this alone, right? So that's been a real encouragement to us to see that happen. And people, you know, they become each other's cheerleaders throughout the course.
I've taught it probably 4, 5, 6 times or something like that. And what I've found probably the most shocking, I had a young married couple, and when it talks about the spontaneity of buying something, you know, that's not on the budget or something like that. The wife, who was very, let's see if I can use the right word, belligerent. Okay, she was not a big fan of any types of restraints. She became very honest, and she says, she basically said, I don't like anybody telling me what to do, not even myself. It's a very transparent reaction to it, which is truth. Now, that was probably several years ago, and unfortunately, she has had lots of other issues, and like, she never followed the plan, but she does know that she is her own worst enemy, and that was probably the only thing that truly she understood in there. So, but I've also taught it to a class, and I thought, okay, well, yeah, there it is, and you don't see these people for 2 years, you know.
Yeah.
And all of a sudden, I just probably about 2 months ago, I got an email from somebody who says, "Hey, you know what? We're debt free." I said, "What? What do you mean?" And they had they said, I think they had $30,000 left on their mortgage. That was the only thing, and everything else was all that, and they were in serious upside down 2 years ago. And I thought, boy, somebody actually listened, you know.
Yes.
It was amazing. So
Yeah.
you get all sorts of different reactions when you teach it. It's sometimes the things you think is going to go is probably not,
Yeah.
but then all of a sudden there's different pathways that it's amazing. Let's talk a little bit about some of the differences between the United States and Canada specifically. The first thing is probably insurance. I guess when it comes to Canada, the biggest factor is we don't have any healthcare issues, healthcare insurance issues. The only thing we may have is maybe disability or WSIB, like workers' compensation or something like that. But that's a provincial factor in there. Disability, you can get disability insurance and stuff like this. But actual medical insurance is something that we don't deal with at all. Do you skip over that whole aspect of it, or how do you handle the insurance aspect, or is it just a very small?
No, actually, it's a whole lesson with a few other things sprinkled in. But insurance is one of those areas that we found people are very negligent in, and maybe, and I use the word ignorant in a truly just don't have information on it, or the lack of information means they buy the wrong insurance or too much insurance.
Yeah.
And so we do teach a fair bit on it, because it is it's part of the security and peace in your finance if you know those insurances are in place. And yeah, we have the luxury in all provinces to have a great medical system, even when we're older. So we don't really touch on that, other than clue in, if you are traveling, even within Canada, you know, cover yourself properly. These are cheap insurances. So we teach how insurance is to transfer risk where we can't afford to pay those things, like our car and our house, etc. But
also
other things to cover.
You deal with life insurance then as well.
Mhm.
Talk about life insurance.
Yeah.
There's one aspect that's a big factor that Dave Ramsey is against, that is actually a lot more prevalent here in Canada, and that is what is it, whole life policies.
Whole life, universal life.
Yeah, universal life. It's much more prevalent in Canada than it is United States. Primarily, in my opinion, it's because we have so few banks, and they do an awful lot of it's amazing how much control the banks have, everything from mutual funds to insurance to also they get their fingers in a lot of different pies. But the insurance industry is very, very pro universal life in Canada, much more so. I don't know what the stats would be, but I would say at least 2 to 4 times the volume of universal life policies in Canada than it is in the United States.
Yeah.
You should look into the actual data on that, because when we started doing our own Canadian version, I actually figured it was kind of becoming history, and I know it's not. And we run into people in every class that have it, and again, I had the assumption that they had it because grandma or mom and dad set up something for them, but no, this is stuff they bought. And in Canada, there's certainly a lot of other terms that they've given it to kind of disguise it, right? And to sell it. And so we talk about that, how it is a marketing tool of the insurance companies. And so.
And again, this comes to education.
Yes.
If you don't know, they're not going to tell you this is one of our products, and it's not a great product, but it's what we have, right? They're not going to say that. So we have financial literacy is lacking in our country, period. So this is why we teach what we teach.
And probably, in my opinion, it's lacking because the insurance companies and banks or whatever, they are totally okay with whole life and stuff like this. And because when it comes to insurance, there's not very many insurance companies in Canada versus the United States. And so we are. It's not that we have monopolies, but we have an awful lot of oligopolies where there's only 4, 5, 6 companies that rule the entire country, kind of a thing. And when they make their choice and decision on something, it's a hate to use this word, but it's a universal plateau of everybody. No, this is the standard. No, it's this, and it's a blanketing of propaganda.
And go to say again that we are insurance, we are not insurance experts. And that's why we keep taking the stance of we're going to educate you. And even things change as 5 years of doing the course, things have changed over those 5 years. And we don't pretend to keep up with everything. But when you say, this is why you need insurance, and this is the logic behind it, and this is how you need to think about it, so that as they come up against their banker saying, oh, you need mortgage insurance, and they go, wait a minute, why do I need that? And they can be not living in fear when it comes to insurance, but living in an educated state. And so that's where we like to keep reminding people, these are the reasons, this is how you think about it. Don't just check your brain out when you go to do financial things. Think about it.
The last course that we taught, so back in February, we had a gent that had taken the course, and one of the things that we tell people to do is read your policies, for pity's sake, right? I know you're going to fall asleep doing it, but read what's in there. So this gent did, and he was way overinsured. Because he had one at his workplace, he had one here, his brother-in-law sold him one, etc. I think he had 4 different life insurance policies on himself. We taught what we taught. Very, very intelligent fella when it comes to knowing things and figuring things out. So he showed me all his math, and he's like, I'm overinsured. I'm like, yeah. So he did the math. He saved himself $800 a month by cutting out what he didn't need and then putting in what he did need. $800 a month. But that he wouldn't have known that because he hadn't been educated on what to look for or how to read it, or
he just kept saying yes. Every time somebody said, oh, I think you need, okay.
So
he could afford it, so he did. But I mean, what you can do with that,
it was money worth the price of the course, which is free.
Exactly. There's a misconception that wealthy people make good financial choices all the time. I know a lot of wealthy people, and I would probably say most of them don't fully understand whole life policies.
Mhm.
They are just as susceptible and sometimes even more susceptible to whole life policies than otherwise. They just don't use a certain amount of thought. There are some things in Canada that confuses whole life policies. I had a friend, for instance, very, very wealthy guy, who bought a whole life policy, and he was able to convert that through his corporation and be able to take things out through what they call a capital dividend account. Okay. It's a very rare thing. I'm not even as sure if they can do that anymore. I think it was a temporary thing. Those kind of situations don't occur in the States because there's very specific laws in Canada to do it. And even then, there's windows of opportunity for it. And he probably saved himself quite a bit. And he also, I think he sold the policy and they got cash. There's quite a bit of different things. And so the laws are written in Canada because it's an oligopoly and there's only like a half a dozen of them. They all get together and say, hey, why don't we put this together? And that creates a market, and then they can do it. So it's bizarre. The people who take either Financial Peace University or the money plan, they'll probably they should never get involved in those kind of things. It's at a level much higher financially in there, and it's very, very unique. But it is in Canada that is not in the United States for sure for that. But anyway, let's move on to the next one, and that's retirement plans, 401ks, IRAs, and stuff like that. Let's talk a little bit about the differences between the two.
Sure. Well, and I'll be honest, I have not bothered to educate myself on the American system because this is where I plan to live. And I think our system is pretty good.
But if you're a listener of Ramsey, you're going to hear those terms, right?
Right, exactly. But I mean, our 401k, of course, is the RSP, which has been a great system. It's, I mean, every system is a little bit flawed, but it's great, and it helps us to work towards retirement. I personally love when they brought in the TFSA, and I'm not sure why they brought it in the way they did, because when we get to that part, people go, what? And they don't understand it's not a savings account.
That's a misconception.
Huge misconception. And I think you are missing out on a big opportunity, people. And so I think that's one of the big takeaways of the week we teach on investing, because then they can go and change how they're doing that. Because they're like, I don't know what the big deal is. It doesn't cost, I don't have to pay taxes on what, $50 I made in the year. I'm thinking, whoa, you've got something wrong. So seeing people understand those terminologies, and again, that's a big one. And as what the new one that just came out, the first home savings account, again, another quirky little one that we've added that I think they've got something similar in the States have had. And I think the TFSA in the States, what's that one called?
Roth IRA.
Roth, right, yeah. The Roth.
Well, so from what I understand, a 401k equals an employer matching RSPs here in Canada.
Specifically.
Okay. A traditional IRA equals RSPs.
Okay.
That's the way it is.
Again, see? This is why we strip those out.
It's a little bit confusing, and why 401k is actually identical to a traditional IRA, but one is done by the employer and one by the employee. Here in Canada, there is, I guess, an employer can contribute to an RSP.
Correct.
It doesn't have to be set up by the employer. It can be set up by the person, and then the company just, as far as I understand, a little bit different from that. But anyway, I'm not exactly sure how many people actually have employers contributing to RSPs. Maybe they do in certain areas, but not in the industry that I'm in.
To the personal. Yeah, I think it's not. Well, I don't know. I'm sure everybody's financial situation is unique, and that's why we educate, and give the understanding so that they clarify
Yeah.
You know, this has a benefit, sure. This has a benefit, sure. Right. So these are the reasons why you would use these tools,
Yeah.
and what a mutual fund is, why you would invest in a mutual fund over a stock, what a stock is. And again, not experts, but we can talk to people on that level where, you know, some of you guys that are so highly educated, CPAs are the worst. They think everybody understands things up here and we all leave confused. So Dave, especially Dave, can talk about it because he's a non-financial guy. So when he understands it, he communicates it really well to people and they leave going, oh, why didn't somebody just say that?
Opposed to bookkeeping nerds.
Yeah. There we go. I do 100% support what you said before. You thought TFSA is awesome. Roth IRA is identical to TFSAs, and I am I'm such a huge believer in TFSA. I have a difficulty considering what is better, maximizing your TFSA or paying down your personal home. That to me, oh, that's a 50-50 kind of a thing. What would you do first? You know, in there.
Doing them at the same time is what we teach. Steps 4, 5, and 6, you're doing simultaneously. So, you know, as long as you're putting it in, what we recommend is 15%. Again, it's personal finance, maybe a little less, maybe a little more, depending on who you are and your financial status. But you're doing those all together. So you're going to get to that place within the same amount of time, give or take a few months, right? Yeah. So it really doesn't make a difference on the long scale.
And we tried this on ourselves. We were our first guinea pigs, right? And we were pretty average, except for maybe our debt was a little higher than the average Joe's. But once you tell Dave this is the way we're going to do it, he makes you stick to it. He's a that's what
I'm a rule keeper.
He's a rule keeper. That's it. So, yeah. So we did the 15%. Like literally, I walked it into the investing guy and I'm thinking, this is a stupid amount to bring you, but this is what we're doing. And we doubled up on our mortgage. And when the annual came around, we dumped the savings lump sum savings on it. So by the time when Dave said we sold our house and became debt free, I almost wanted to keep it for a couple more months because we were so close to paying it off. And that would have been a wonderful milestone, but it just wasn't the way things worked out, and we couldn't have forced it any better than it happened. So we had maybe 50,000 left on the house, so it wouldn't have taken us long to pay that off. So to say it works, like that was another 18 months to get out of debt, and another year and a half. 2 years, let's say generously 2 years to get out of the house and to be investing 15% throughout that time. So I think it can be done. And this is human nature at its finest. And we talk about this in the courses. People love to jump the steps because they're smarter. When the point of working through your debt, smallest to largest, is because we need the little wins, and the interest rate really doesn't matter over that year and a half.
I was just thinking what she's saying, and I hear your question, and from a math perspective, I totally understand what you're saying, but what we teach is it's not about math, it's about behavior. So if we can help people change their behavior towards their finances, then that is the key.
Right.
Let's talk a little bit about a few other things before we get into the actual baby steps. We'll get into that shortly here. But Every Dollar app, does it work in Canada, and do you use it? I'll have to make a confession that I don't use it. My wife and I right now we're in I guess we're in baby step 7. Have been for about 2-3 years, something like that. And we have a system that we just don't spend above a certain dollar figure. And if we do, then next month it's less, that kind of thing like that. So it's very, very open. My wife and I both are not big spenders. We went through a period where we did spend an awful lot, sort of like Costco every weekend kind of thing, but we don't anymore, and so we don't need to track every dollar. That is one thing that is a little bit of an issue, I guess, with a lot of people is, do you track every dollar all the time? And when you are in debt, a person has to track every dollar all the time. When a person doesn't have a 3 to 6 month emergency fund, you have to track every dollar until you do have that. Once you are above that, how do I say this? I appreciate Ramsey's fervent adherence to his policy. But if I listen to what he talks about, and I have listened to every program for 3.5 years, he has spending money in his pocket, several $100s in his pocket at all times that he can spend on anything that he wants.
Yep.
He does not track that.
Yep.
And
but he has
doesn't
tracked it, right?
What's that?
He doesn't track what he spends it on, but he tracked that it got there in the first place.
Yeah. And so, and what he has in his pocket, an awful lot of people don't have that as a margin.
Right.
Mm-hmm.
Once you get to a certain wealth earnings or certain earnings, I used to round everything down to the penny. I knew where every single penny.
Yep.
Then I make a certain amount. Okay, I'll round it off to $10. Then I round it off to $100. Now, when I do cash flow projections, I round it off to 10,000 here or there. And so your mindset has to change because you can't be attentive to that much detail all the time and still be really productive, especially if you're growing and your finances and expanding and all sorts of things. Too much of your time can be taken up on there. You have to have a system that is realistic. So I do very much agree that until you have your 3 to 6 month, then definitely you have to always watch every single dollar or every single penny. But after that, you should have the freedom to round things off and be able to live within a certain thing, as long as you keep tracking it. So if it continuously goes up and up and up and up, well, then wait a minute, you got to bring it down somewhere.
I think this is where we would probably say that's a personal finance decision, depending on who you are, depending on how you handle money. So that would be at one end of the pendulum. At the other end of the pendulum, you'd find me, because even though we are debt-free, we have a substantial life savings and retirement plans and all that. We track every dollar. So we do our budget every 2 weeks on payday. So money's in the bank. We tell the money where to go before we spend it, and we do track it down. We still use the zero-based budget. Mm-hmm. That is the key to success for us, and has been for those that take our course as well. We follow up at 6 months and a year with our people, and that is the number one thing that people say that they take away from this course is the zero-based budget. It's the tool that helps them achieve success.
And what you're talking about, Robert, though, is you've already changed your habits. You've already changed, you've applied those things, and that behavior change has happened. So for you to operate like that is perfectly fine. And you know yourself that when you go out of whack, you're there, and you also have agreed on spending limits. And so that's a big thing right there. Again, as I said, we have to, because we teach this stuff. It is much looser than it used to be when we were in debt. And I mean, we were down to, okay, $5 can go into savings. And Dave was serious when he meant that $5 was going to savings. Now we have much bigger surplus at the end because we just don't have time to even spend the money we make. And our habits have changed, our behaviors have changed. And so some weeks, that $1,000 didn't quite get over there yet, let's say into savings, but it's still sitting there waiting to go into savings. It didn't get spent,
right,
as it might have 20 years ago.
Oh, guaranteed I would have spent
yeah.
I got $1,000. I'm spending
He
it.
didn't even know it was there and he would have spent it.
I'm down to a penny. I'm an accountant. I can go down to the penny. One of the most bizarre stories is when my wife and I were driving truck. I had this trucker's wallet. I mean, this is probably 2.5, 3 decades ago. We had a huge leather thing or whatever, and you had 3 columns and 2 zippers in there, and you had all Canadian cash and Canadian receipts, and you had all U.S. cash and U.S. receipts. And I balanced that thing out to the penny every 2 weeks to a month or something like that, depending. And religion, I could do it right down to the penny, right down to the penny. Then we were in Mississauga, and there is a Swiss Chalet on Dixie Road. Okay. And we went there, we parked, and we went inside, had our meal, gave them the cash, put everything all properly. And then we were walking out to our truck, and I looked down on the ground and I seen a penny. And I thought, oh,
I know where this is going.
penny, right? I pick up the penny and I look at it, and it's a US penny. Oh, so should I put it in the US amount or in the Canadian amount? And then I go, wait a minute, how do I record this? Or is this expenses? And there is no exchange rate if I put it into the Canadian one. And I'm thinking all these things.
Wow.
Meanwhile, my life is ebbing away because I'm an unbelievable amount of energy expended on a penny or a fraction of a penny. And eventually, I think I decided it was a negative meal expense. That's how I recorded it in there. But I was thinking about it afterwards, and I said, that's an unbelievable amount of effort to expend on the details. If I'm going to be financially free in my life, I'm going to have to learn how to do things a little bit differently than everything down, because I certainly wasn't a nice person to live with. I'll tell you that every single penny, this, that, and the other, and stuff. It was you have to really watch out what you do. And that was a life-changing experience for me.
That was worth finding that
was
penny.
worth a penny.
Yeah. Wow. Great story.
Okay, so let's go through some of the baby steps and see if there's anything Canadian versus US and what it may or may not have to do. The baby step 1 is an emergency, $1,000 emergency fund. Do you espouse the same thing?
We do. However, this is one that we let people know. Number one, if you're a student or you make below like $24,000, $500. But for most people, like, let's get that $1,000 there, because what that's going to do is basically be insurance money setting aside. If something breaks, you got the cash, you could replace it or repair it. However, we let people know that number has to change depending on your circumstances, depending on your situation, because it's personal. So for us, our story is we had to, at the time we were delivering mail for Canada Post. And so as a rural post driver, we had to provide our own vehicles. So if something happened to that vehicle, I'm out of work. So we decided to make ours $5,000 just because we needed that $5,000 in case something happened. And you know what? It happened. The car died on a Friday. Saturday, I'm looking at cars. Sunday, I have the new used car in the driveway, and I'm ready to go back to work on Monday. No emergency, no chaos, no fights, that protected us. So, but for most people, we say get $1,000 in the bank and let's move on to start paying off your debts.
And that is also the beginning of behavior change.
Yes.
Because people who are in severe debt say, where do I get $1,000 from? I'm behind in everything. So that's I'm serious about this thing. I'll do step 1.
Yeah. So your $5,000 rule for yourself, that was primarily because you were self-employed.
Correct. Yeah. So you got to look at the personal side of that, and for somebody else, it might have to be $10,000, right? Depending on their situation.
We deal with independent operators,
right?
Highway tractor owners, and $5,000 can disappear very, very quickly.
Right.
And that's very personally, I don't think I would ever. I start panicking if something would go below 25,000 if I was an independent operator, you
Right.
know. But the point is that what it brings out is the panic. You have to be in a panic mode, and whatever it is that helps a person to panic, because I would panic at 25,000. I had a client in here who said, "Look, I got some truck and repairs, and I don't have any money to pay for it." And I says, "So when did?" He says, "My line of credit is completely used up." And so I told him, I said, "So when did you start panicking?" He says, "Well, 2 weeks ago when I found out that my line of credit isn't going to be enough." I says, "You didn't panic nearly soon enough." And is sort of flabbergasted at it. And it's, you should have been panicking back, you know, at the very least when you had zero in your account, or at the very least when 5,000, 25,000.
Right.
And panic is a choice, and it's a clear choice. And I baby step one, $1,000 emergency fund, it brings out panic. So a person is in continuous panic mode. What do they call that? It's not panic mode. He doesn't go. What does he call it? Not intentional, intense. Yeah, that's what it is. He calls it intense. Ramsey calls it intense. So you're intense and you're always in panic mode until you're out of debt. And that's $1,000. And that's, if you listen to Ramsey quite a bit, that's probably one of the biggest things that they said, that $1,000 is just not enough. It's just not enough. It's designed not to be enough, because you have to be in panic mode always. And
however, it's surprising to us with the stories that come back. Quite often, the $1,000 is enough. And you know, somebody's basement leaked, it was enough. Somebody's car tires blew, it was enough, and it kept them from putting more debt onto their credit card. And that's the point we try and make. No, it's not enough. It's not an emergency fund. It's a beginner. It's a beginner emergency fund. It's keep yourself from more debt fund. And like, I like that panic, but it puts the pressure on to get out of debt.
Yeah.
Right?
Yeah. It's in its self-imposed debt. Okay. Baby step 2, which is paying off your debt, and that the smallest to largest. Do you get any flack from smallest to largest versus interest percentage rate? But I got 0% interest.
There's always a nerd that says, no, I've got to save the $5 in interest. You know, get her done, boys. Don't get the math done. Get the debt gone. And so if people are serious, if they're at the bottom of their rope, at the end of the rope, they say, fine, I'll try this, because doing the math side, it didn't work. Like they keep tapping out, because those big debts take too much energy, too much emotional energy to get through. So you can pay off the $500 couch loan or your small visa, then you like, I'm a rock star this month because I did something different.
What we teach is definitely the same thing, because it worked for us and we've seen it work for others. And as we discussed earlier, you know, at the end game, when you've started and you've finished, you might have paid a few $100s more in interest, but you got those, what we call small wins at the beginning, right? We paid off that small one. And if you're starting and yours is a large one to begin with, let's say yours is like $20,000, that's your first small debt, could be. We encourage people, chunk it up, you know, make it a $5,000, you know, you're going to pay 20, but you know, $5,000, celebrate that win, right? Go out for dinner or something within reason, and pay cash. But and then, you know, at 10 and 15 and so on. But that way people get traction and they see that they actually can do this rather than being discouraged. And what happens is, if you're discouraged, you give up, you quit, and you get nothing done. So that's the same game plan as what he teaches. We call them the money steps. It's the same stuff that Larry Burkett taught to, right? You know, and Grandma, we have one in our course right now. She's like, yeah, I taught my kids this.
Yeah, that's most people who call in are in baby step 2. And because that's where a lot of attrition actually happens. People lose heart.
Yeah.
Because it's a long slog to get out of debt. It's really fast and fun to get into debt.
Yeah.
It is a long, slow slog to get out, and most people lose heart.
And
Either
that's
they
that-
lose heart, or they get distracted by a shiny something over there, and then they start all over again. Yeah,
Sure
it's
enough.
and money step 2 is where the behavior change happens. And that's where the zero-based budget is so important. And I mean, part of what we teach is, why doesn't it work? Because they're not doing it and they're not following it. And that's the only reason they can't get out of debt, is because they sort of kind of do it, but not really. And it will never work. But that means they're not changing their behaviors.
Yeah. Okay, baby step 3 or money step 3,
Mhm.
is 3 to 6 month emergency fund. In understanding this concept, even at the MBA level, they don't teach this from a personal financial perspective. Like, I do all sorts of like corporate stuff and what they taught, like shouldn't say commercially, but classical education does not say a 3 to 6 month emergency fund for personal finances. Actually, they don't teach much personal finance at all.
No, they wouldn't, would they?
At on there. And it's actually viewed a little bit like a fantasy. Why would you need 3 to 6 months? Well, maybe then you put it into mutual funds. No, you're supposed to put it so you have direct access. And it's viewed as inefficient use of capital. And you wrestle with a little bit greed. If a person says, "Hey, it's got to be making money for it," no, it has a purpose,
Mhm.
and the purpose is not to make money. Its purpose is an emergency fund,
Yeah.
and that one, the 3 to 6 month emergency fund, it was for me, it was a difficult one, because either I was too aggressive or too efficiency minded, that I had to wrestle with it. But it personally, my wife and I made a huge difference. A number of years ago, we jumped in a vehicle and we just went out to Prince Edward Island with a vehicle, and on our way back, the engine blew on our Honda, and it didn't completely. I think one cylinder went or something like that. So we had like 60% of the normal power or something like that. So we limped it home, and the like. But we never worried, because we had all the money we needed for it. So we joked around and took our time and did it. It is a completely different lifestyle when you have your bills paid for.
Yes.
You have your emergency fund. You really don't have an emergency anymore.
That's right.
You just come
Yeah.
in, okay, do that. 2 weeks later, you get the vehicle back. Here's the check, and it's done. That level of peace of mind is almost priceless, and people rely on their credit cards to do that, and that creates the stress. It's stress inducing when you have to use credit cards, and it was a foreign concept for me to have 3 to 6 month emergency fund.
Well, that's the same that we teach as well. And one of the things that we communicate to people, you mentioned that you felt like it was a useless, inefficient use of money. The most inefficient use of money that I can think of is insurances, right? Because it's like, I get nothing for it until you need it.
Yeah,
right. And so an emergency fund, if people can change their thinking and consider emergency insurance, it's your money. It's sitting there should you have an emergency, but that's all it's for. It's not to make you money. It's not to do anything other than to cover your emergency. So it's emergency insurance is what you're really investing in, and it's yours. Yeah. So 3 to 6 months, depending on your circumstances, again, personal finance, if you've got a very stable job and it's secure, and 3 months might be enough. And then, but if you like to sleep at night, knowing that should something happen or something affect your health, that 6 month is going to help you. So it is a big number. And the problem with us humans is when we get that big number, because we were, when we think about it, probably like just a few years ago, we were in financial mess. Negative, digging out of debt. Now we've dug out of our debt. Now we're building up our emergency fund. Now we get it. We think we're financial experts. And we're so far away from that. But we think we know best. And the reality is, if we do this, it will help us down the road.
Mhm.
Not too long ago, CTV, I'll send you a link. It's rather interesting because it's CTV putting out how to recession-proof yourself, etc. So I'm like, oh, cool article. I'm like, no way. It was almost like reading the money steps. This step, this step, this step, and they hit on that 3 to 6 months.
Yeah.
Have that in there. So it's like, the information's out there. People just have to have the desire to do this. How badly do they want to be out of debt and be prepared for their future?
Yeah. And you use the word fantasy, I think, and we hear that a lot with people that are in step 2 in debt. Is they're like, I'll never be able to do that, and that's quite actually an encouraging moment with people, because it's like, yes, but what are your payments right now? So if you were to take all those payments and you didn't have them and you could put them towards saving, stop and think how that it won't take very long to save up. Like because they're just so used to that hamster wheel.
Yep, exactly.
Always paying a bill, always trying to catch up to last month's paycheck, right? So it's a good one. It is a hard one for people, though. Yeah.
Mhm.
Okay, baby step or money step 4, 15% of income into retirement savings. Is that too low, too high? Depending on the age, a little bit. Is that in Canada, is that the right amount? That kind of thing.
Yes.
The right amount?
Well, you know what? We went into this very late in life. We got out of debt. Like you said, 5 years were completely free. We'd been investing a few years before that once we'd gotten out of our consumer debt. But we were in our late 40s, let's say, if you average us. And we started. And so we went to financial advisor, and you know how they will plug in all the numbers into their formula. And that's a fascinating thing for people to do if they've never done it, because all of a sudden you realize, oh, I got more going for me than just this, because they start looking at future government income and stuff, right? And your house sale or your appreciation on the house you own. So that's a good exercise. So when our fella did that, he said, okay, if you put 15% of your income into investments, that'll get us to where we need to be. And we kind of looked at each other and went, really? We were really expecting to have to dig deep and start catching up because we were so late starting and doing anything. So again, when we get to teaching this, we're like, you know what? Go find out for yourself, but
what's your number?
What's your number? And unless you've got really high aspirations for like buying a yacht and living, a really luxurious life when you're retired, most people just want to live comfortably and not worry about, or borrow money from their kids or things like that when they retire. They want to live a similar lifestyle. So probably if you're midlife, 15% is good. If you're younger, it'll probably be a lesser number, but they're probably on top of it. So they'll probably put 15%.
And the fact is, most people haven't thought of this.
No.
So this is a starting point. And once you're at that step, you're doing money step 4, 5, and 6, right? Once you finish off 5 and 6, hey, you want to throw an extra 10% in there, go for it.
Yeah.
You're going to max out your RSP, your TFSA eventually, and then you're going to start into doing some non-registered investments as well. So, or be outrageously generous and put it to work somewhere else.
Right.
Now, I'd like to come back to this 15% because for myself in Canada, there's a little bit of a conflict between baby step or money step 4 and baby step money step 6, which is pay off your house early, and especially now that interest rates are starting to rise.
The math,
we're paying interest on our mortgage with after-tax money. And so you have to convert that in order to, because if you're putting into RSPs or something like that, you have to compare after-tax to after-tax. And realistically, if somebody has a mortgage of 6%, for instance, realistically, that means that it could be as high as 8 or 9%, the equivalent in an RSP. And it's guaranteed 8 or 9% if you pay down your house. And it's not necessarily guaranteed in an RSP. Every year you're going to get 8 or 9%. You know? I think on average an RSP gets 8.5 to 9% in Canada, something like that. So it's almost at par. But you're guaranteed that return if you pay off your house. So it's very, very close in Canada. We really focus on 60% of all people use their house as a retirement. That's their major retirement plan in there, and it's true. The fact that you can sell your home at a profit in Canada without paying taxes, that's one of the best features of the Canadian tax code, and in the States as well too. Now they have a cap, I think $500,000 or something like that. I think Canadian has a cap as well, but it's an exceptional factor in Canada. So if somebody asks me, do I invest in mutual funds, and if he's really leery on mutual funds in RSPs or something like that, I say, you know what? Then instead of doing that, just throw it to your mortgage and do the same thing. But that's again a personal thing.
Right, and that's where we would probably say to that person, because at this point they have a financial advisor.
Yeah.
Talk it over with somebody that's going to walk you through that and just give you good counsel.
Weigh out those options, right? As opposed to right.
The only thing is about a financial advisor. If you ask a financial advisor, you say, "Oh, now you go to 15%," because doesn't he make a commission on
a good financial? Okay, so that's one of the things too. A good financial advisor has your best interest in mind.
Yeah.
So we found we have a great financial advisor.
What does the individual feel most comfortable with?
Yes, right.
Right, and that's the whole point of the
mutual funds. Well, then pay off your house.
Right. Yeah. And part of when we teach about investing is we teach about diversification, which is part of the principle of why 4, 5, and 6 can be done, or quite often are done simultaneously. I mean, unless at that point you have a shortage of income for some reason, but if you're out of debt, most people now have a surplus. So if you put in whatever your number is, 10, 15% into investing and do the extra, because you can only do so much on your house, right? You can double up or you could be saving for that lump sum at the end of the year. And so if you set some targets like that, most people can be doing them simultaneously and thereby, hedging their bets that, the housing market is going to go up, because it is an excellent inflation hedge, of course. So
yeah, that's a good point Bill made as far as the mortgages, because when you're going into a mortgage, it's good to think ahead.
Yeah,
because there's so many, as we found when we wanted to sell, it's like, we had to take a little bit of a hit, but we did it. So those kinds of things affect
early kind of a thing. You mean when you were paying out your mortgage early, you had to take a little hit? Yeah, there are, when a person takes out a mortgage, like if you're taking it out every 5 years, like, because you have to renegotiate it, you can get a mortgage that you can pay out at any time without.
Right, you pay a higher rate for that.
Yeah, slightly high. It's not that much big of a factor, but if you're focused on something like that, it's something definitely to consider in there for sure. Let's talk a little bit about baby or money step 5, college fund. In Canada, my understanding, the student loan crisis is not nearly what it is in the States. It's wildly exaggerated in the States, as well as, to my understanding, student loans under bankruptcy, student loans in the United States are not, they still survive bankruptcy. In Canada, to my understanding, they can be written off. Is your understanding the same?
Yeah, I think there's some timelines as far as how long you've been out of school and whatnot, but I believe it does get wiped away. And they have some, whatever the governing body is for the student loans, they have a repayment plan that they try and avoid.
Yeah,
sure. Right, of course, but no, they can be wiped out.
I think if all the United States does is make student loans bankruptable so that they can write it off, that would make a huge difference in people borrowing in the first place. And that would then have a sort of a domino effect on student like tuition and stuff like that too. I think there's
might throw their books terribly out of whack though if they started letting those be forgiven.
It's pretty big. What is the general understanding from what you understand about Canadians paying for their children's education? I think it's really popular in the States. What about Canada?
I'll take this one because that always bothered me when I listened to the radio in the States, is that I got a sense of I'm a poor parent because we have three grown children. We were in financial disrepair when they went through school, and to the point sometimes I would borrow from my student daughter because she had more money than I had, which was a horrible thing. So we're listening to Dave Ramsey, and I'm thinking, I am the worst parent in the world because I didn't pay for my kids' education. I didn't go into debt for that. I could have gone into debt for at least that. So when we started to teach this, that was really important to me that we stress this is personal finance. Don't let anybody else tell you how to help your kids through school. So some people can, and that would be awesome. Some people can let their kids live at home, right, and go to a local school nearby. There's all kinds of options. So we really stress that. And having grown children that went through school unhelped, and talking to them about it after the fact, they said, no, I think it was a good thing to have to work through school. We have friends that went on a meal ticket through and they didn't struggle, but they struggled with other things because they didn't have to worry about working. And she said, my daughter said, I think the best way, if a family could afford to do it, would be to let the students struggle through and then pay their debt off when they got out of school, if they could afford to do it, but not to pay their way through, because it's just teaches the wrong thing to the students. And I thought, wow, what wisdom she had.
Yeah.
So anyway, that's back to though, how you help your kids through school has to be a personal decision, but I really love to take the shame off that one because the Americans really put it on heavy.
Yeah, they do. I totally agree. I do. They emphasize it more. And I think our system, a lot of it, so much of it is subsidized by the government that the actual bill is pretty low.
Yeah.
However, with the RESP, free money.
Yeah, that's right.
You know what? As soon as that child comes out of the womb going, wow, start investing.
Doesn't the RESP, can't you convert it also into RRSPs or something like that in Canada?
Your portion can roll over. You have to give back their government.
Yeah, if you don't use it for education.
Yeah.
It must be used for education.
But it can stay open for long enough for our
up to 35 years old.
Our students living at home for so much longer than they should. Those students, when they're adults, can still use it for education. So it's not really like they got to use it when they're 20. They can use it when they're 35 and get out of the house.
So we recommend the family plan.
Yeah.
Not individual, but you can do in a family RESP. That way anybody can use that for education.
Right.
Yeah. I used back before there was RESPs back then, but very limited, and I think it was cut off just as I was about to need it, because we went driving truck until I wanted to finish off my master's degree. So we saved up money, but we just threw it all into RRSPs. And then when we got off the truck, and then we had a whole bunch of tax deductible expenses, and we weren't working. So then I could take out my RSP. So I kind of used that as a way to level out somewhat. But that was for myself personally.
Did you use it like the lifelong learning plan where you paid it back, or you just took it out and paid taxes on it and used it?
I took it out. I paid. Actually, at that time, I took it out. I paid the taxes, but I got the money back because it's just straight income, right?
Yeah. Because your income was so low.
Yeah, back then also there was a program for a temporary time where if you could take money out of your RRSPs, and if you were a first home buyer, you could apply it to it, and then you had 10 years to pay it back. That was another program that I used at the time to balance things out. But other than that, I used the RSPs quite a bit. I actually have virtually no RSPs now. And it has primarily to do with my business. By the time I retire, my business has so much assets in it and I sell it, I'm going to be paying triple the taxes if I also have RSPs. So it doesn't make sense for me to TFSA is yes, but everything else is all in my corporation. And but that means I'm making the assumption there's going to be a whole bunch of wealth when I'm 70. So it's a little bit of a gamble, but not really that much because it's all in real estate right now. So, but the vast majority of people who have a paycheck to paycheck, RSPs is a pretty good thing. TFSAs, I believe, is still the best, but RSPs is definitely the secondary in there. So there are a couple of issues that we can talk about. Owning vehicles without a car loan is counter societal norms. Very, very different. I wonder how much of a difference it is between Canada and the United States. I do know individuals in Canada, quite a few individuals in Canada who have no car loans. I would assume as a percentage, there'd be much more people in the States with debt on cars than in Canada. But maybe my experience is a little bit skewed because where I geographically am and the people that I know. Is automobile expenses always a big factor in does everyone...
I don't know any statistics on that, but I mean, if it's any indication as to the number of car dealerships there are around, I think we're pretty much per capita on par with the States.
Yeah. And I think anecdotally with the groups that we have come through, I would say back to that 35, 55 mid-range working class person. A lot of them just, as you said, it's just a social norm. I just go out and I buy a new car and put on payments. That's the way things are done. There's a different way. Nobody told me I could do it differently. That's kind of the conversation that we have. Or what do you mean I can pay my car off? And I'm thinking, I get that with a house, but a car, it's not a big
deal. Well, for example, our daughter, where she is employed, she bought a car and she paid cash for it. And her colleagues who are older than her were like, how did you do that?
Yeah.
And our daughter's like, with cash. And they just couldn't, that's not what you do. You have to have payments.
Yeah.
So,
and it wasn't for lack of money. I don't think in that case, it was just a lack of, just
like you have to have a mortgage, right?
Yeah.
Like if you're buying a house, you're buying a car, you have car payments.
Yeah.
So
I think there's a little bit of a difference between East and West Canada. Quebec and Ontario have an awful lot of car leases. A lot of people lease vehicles. I know primarily because once they are returned, and traded in or whatever, they come out west and people buy them out here
used.
and they say, well, is this from the East? because you guys use much more salt on your road than we do out here. And so there's a lot of consider when it comes to that. And he says, well, I'll never buy a vehicle from Ontario or Quebec because it is too much salt or whatever. So there's this geographical difference, and mindset is a little bit different too. If you go to Manitoba, Saskatchewan, and Alberta, there's a certain amount of people, well, especially Manitoba and Saskatchewan, much more farming community, and that agricultural mindset is no car loans, don't need no car loans. So it might be a little bit lower in Manitoba, Saskatchewan, but that's just my guess on it. Alberta is a little bit different because when they have big move of oil, everybody buys a new vehicle.
Right.
It's just like that's the first thing they do. There is no old vehicles. The old vehicles in Alberta, they come to Saskatchewan and Manitoba. Automobiles are very, very different geographically. It's very, very unusual. There is one thing as an accountant that I talk about when it comes to an automobile, and that is annual auto costs. And in order to calculate what your annual automobile expenses are, you have to take the purchase price, you have to subtract the sale price, and then you have to divide it by the number of years owned. So in other words, the longer you own a vehicle, the less it costs. Mm-hmm. And that is a huge factor. There are some people who buy and they basically overpay for a vehicle. Mm-hmm. And they say, well, okay, well, I overpaid, so now I'll just trade it in. Well, whoa. Just hold it on for 2 or 3 more years than normal. Just keep it together, and drive it for enough years to bring the entire cost down. And it's not popular. You have to be humble maybe in order to do it, but that's really the only way to do it. There are some people who buy used vehicles and they look for a smoking hot deal, and then if they get a really good deal, and then on top of that, they stretch out how long they own it, their annual automobile cost could be just a fraction compared to the guys who buy brand new who lease brand new vehicles, and they have to write off that lease payment. That's the automobile cost. And so there's different formulas in your mind, different options and opportunities for individuals. And it's not always, I got to buy new and just hold on to it, and this is keep the lowest cost. And all they think about is fuel cost. They say, well, okay, if I buy a big vehicle, there's lots of fuel, so I want to keep my annual thing. No, it's the biggest cost is actually the depreciation of the vehicle. Mm-hmm. And also the secondary is insurance. If you have a $50,000 SUV, and to insure that thing could be, $3,000, $4,000, $5,000. Well, maybe not $5,000, but $3,000 or $4,000. Or if you have a $15,000 Toyota Camry, well, now you're looking at whatever, $1,500 or $2,000. There's huge difference in actual carrying costs that has nothing to do with the actual fuel that you're putting into the vehicle for sure. And that's a big thing. When you're young, I like what Dave Ramsey says. When you're young, you drive like nobody else, so that later in life you can drive like nobody else. I admire people with beat up old vehicles while they're getting out of vehicles, or getting out of debt. That is a huge. That's one area that a person can really save and multiply.
The fact of the matter is, if you own a vehicle in Canada, you're in the top 5% of the world, as far as wealth is concerned. So that alone says something about having a vehicle. You're wealthy because you can afford the insurance, you can afford the maintenance, you can afford. So I know when we, before we got on the plan, we had made one of the worst decisions. We bought a new car because ours died, but we went out, we bought a new car because we couldn't get, how messed up we were. We couldn't borrow a few $1,000s from the bank, but the car place where we got our car, they would give us a car loan. So we went for it. So fast forward to when we're out of debt, we're paying off our debts. We go to pay off, I think it was $13,000. We were just going to go, bang, here you go. Isabelle goes in the bank. I'm waiting in the car for her. She's in there for like almost an hour. I'm like, what gives? It's like, pay the transaction, come, let's go. She comes back. She's like, you wouldn't believe it. And they didn't know how to process the payment. I've never done this before.
No, you can't. You can't
Oh yeah.
do this.
First it was, you can't do that. I was like, well, yes, we can.
My loan, I'd like to do it.
Nobody's ever done this before. Manager. Yeah, so that's how unusual it is to pay off a car payment, we found.
Mm-hmm. I think when we're comparing the two, Canadian to the US too, when it comes to used cars, one thing that has come to my attention, again, let's thank my daughter. She's great at applying. She's another rules person. So she had a used car and she milked that thing to the end because she said, do you realize how much it costs to flip cars in Canada? In the States, it's obviously inexpensive, but by the time you put HST on top of a used car, so that whole, well, buy a $2,000 car, which, you know, again, in Ontario, during that time, we had all the emissions stuff. So could you buy a $2,000 car that passed safety? Not necessarily, but if you could drive it for 6 months, flip it for a better car like he teaches, it's like, it's not really practical. Financially, it wasn't the wisest thing to do. So she just kept driving that poor car. And then she did flip it for a, you know, a $7,000-8,000 car, and then drove that thing, actually sold it because when used cars were so in demand, she said, they're actually going to give me most of what I paid for it. So she upped into a you know, $15,000-17,000 car and is happy as a lark. It took her probably 8 years, whereas Ramsey would have said, oh, you can do that in 2 or 3 years.
Yeah.
Well, it didn't make a lot of sense with all our taxation here. So
yeah, our taxation is it's a little bit of a minefield. Like HST is ridiculous. What is your suggestion when it comes to how expensive a vehicle does an individual purchase in Canada? If they make, the average in Canada is what, $65,000 a year is average. So what price of a vehicle do they drive? What do you recommend?
Within your means, again, personal. I know Dave puts a number on it and he doesn't, you know, don't have more, forget his percentage, but like
it's 50%.
50% in engines, right?
Yeah.
If you're living out in a rural area, you need something that's durable. If you're in the city, you don't necessarily need the power of a truck. So the dollar value, I don't know.
yeah, and you know, and that just takes me back to here in Canada, FPU, is his forms had all those percentages and it messed with people, very intelligent people. I remember going, oh, well, my car is more than, and it's like, but you own it already, or you have it in your driveway, pay it off. That's more important that it's paid off than it fits into that. And so we completely stripped those percentages off of our teaching because
you need a car. You don't need a Ferrari, right? Like you need a vehicle. If you need a vehicle, you need a vehicle. If you can live in a city, we urge people, you know, if you're in Toronto and you don't need a vehicle, you can Uber, you could take public transit. I mean, you could walk, you can take a bike. I mean, do whatever you have to do. If you're in money steps, you know, 1, 2, 3, do whatever you have to do. Then, you know, within reason.
Yeah, and I don't, you've probably found this with wealthy people that have changed their mindset with money, where it works for them, is that then the car value doesn't actually matter. They probably drive some pretty plain cars.
Generic,
very, you know, they buy cars that do the job that they need them to do, not to impress anybody.
I know a fair bit of millionaires. I know a few Deca millionaires. The Deca millionaires have about a 50-50 shot. They do buy brand new vehicles, like $80,000 vehicles or something like that, but it's such a small percentage.
Exactly. Right. Yeah.
It doesn't make any difference.
And they're probably paying cash.
Yeah. The millionaires, almost all of them, I would say at least over 90% for sure, don't buy new until later in life. They're all over 45, 55 before they buy a new vehicle, if they even buy a new vehicle. When they're young, if they bought a new vehicle when they were young, they realized right away that they made a mistake. And then they do the corrections, and then they say, well, I'll never do that again, kind of a thing, you know. And I was extremely lucky in life. When I was 19 years of age, I bought a gorgeous Camaro, beautiful red shiny Camaro or whatever, and I spent a week polishing that sucker up, you know, polishing and washing and what. After a week of putting 15 16 hours of just washing and polishing, I said, what in the world am I doing with my time? Just polishing this thing up. And all I'm doing is I drive down the road, a gravel truck has a couple rocks that come out and chip here and chip there, and door dings there and stuff like this. And I says, this thing is just going down.
Right.
And I love the car. And then all of a sudden I said, what? I am not a car person at all. Because of that, I just say, I don't care what I'm driving. And I've never bought a new car. I've actually never test driven a new car because I have zero desire for it.
Right.
But that's an anomaly. You know, I mean, my parents have bought brand new vehicles. That's not, it's not like I'm not, it's just that I've never felt that I'm wealthy enough to buy one. And even if I was, if wealthy enough, and I am wealthy enough to buy one right now, I don't have a desire. It doesn't turn me on. There's things that turn me on that other people, like I could be in Staples and I could be there for 4 hours. I'm weird that way because I'm an accountant, you know, that's what turns me on. But a car, I don't care. I have a friend who has a 25-year-old Dodge thing, and it's rust holes everywhere. I don't mind driving in that with him, not a problem, you know, because it's an A to B thing. It's not whatever. But I know I'm an anomaly in that regards. I don't do it, but it's a car ownership in Canada is, I mean, it's very personal, it's an interesting topic for sure, and it's something that people have to overcome. It depends how wealthy a person wants to be. That's one thing you have to deal with. If you want to be really wealthy, you have to deal with it early in life.
Yeah.
And you can have it later, but
yeah. Well, you said drive like no one else, so you could drive like no one else. Yeah. We actually did that. Isabelle's had a desire for many years to purchase an MGB. Right, if you remember the old British MGBs. So at the beginning of 2020, it's got a full 88 horsepower. So, but we purchased one, and we considered the opportunity cost. It's like, you know, it's going to cost us, I think we paid $8,500 for it, and so the opportunity cost is, you know, we take this money, we take it out of our savings. If we left it in there for another 30 years, this is how much it would earn. Mm-hmm. So do we want to do that? So we weighed that out, but we purchased it. We live in Niagara region. We live in wine country. It's an amazing place. We got the top down. That's our
like a little Triumph. Is that like a
almost identical?
Yeah, same kind of idea.
So you know it's something. But drive like no one else. You could drive like no one else.
Yeah, for sure.
And people look at the car and they go, "Wow, that's really." It's like, it's $8,000. Like, seriously.
Some people spend more on 1 week of vacation than we have on the card, right?
Exactly. Yeah. Okay, now let's talk a little bit about home ownership in Canada versus United States, and primarily mortgages, I guess. Ramsey Solutions talks about 15-year fixed mortgage with a payment of 25% of home earnings. That's after-tax earnings. That's just not possible in Canada for a couple of things anyway. And the first thing is Canada does not have 15-year fixed mortgages. We have 5-year terms. It can be amortized over 25 or 30 years or 15 years or whatever you want to set it at. But everybody renegotiates every 5 years. And in my opinion, that's because we have only 7 or 8 chartered banks, and it's an oligopoly, and they say, nope, we don't want to take on that risk over an extended period of time. We're going to have our whole country do things to our best interest rather than theirs. So we have to renegotiate like crazy. And right now, we are finding people who bought like crazy in 2020, 2021, and even at the early 2022. Say 2020, they are going to be renegotiating their mortgage in a year or two, something like that, depending on a few terms. The probability of their 2.75% to 3% mortgage being 6-7%, double amount in a year and a half, 2 years from now, is extremely high, because interest rates are not going to be going down in the next 2
Not as
years.
quickly as they went up. That's absolutely right.
And there's a lot of people in the States who have a 15-year, they don't care, because in 15 years it's whatever. But in Canada, we're going to be having, where we have a slow motion car wreck that is everybody is sitting and waiting and watching.
That's
And
a great analogy.
it's a slow motion car wreck for sure. It's really scary because there's people who grossly overpurchased.
Yeah.
And then on top of that, they now have to refinance. They're going to have to downsize.
Yeah.
And it's a sad thing for sure. In there,
the mortgage rates up where they're headed is, I was thinking the other day, it's like we had the mortgage at
8.5%.
Yeah, 8.5%.
Back in the 90s, yeah.
I'm thinking, okay, not a big deal. And then I went, yeah, but our house value was like 150, 200,000.
No, it was 80.
Oh yeah, that one was 80.
Yeah.
Which was a lot for us at the time. At 8%, it was still plenty, but it was manageable at 80, 100,000. So you tack a zero onto that. Oh my goodness. My heart just races when I think what people are in for.
We know several people that are in the boat that they bought in 2018, and this
Right.
is coming up in February for them. And
Right.
like we said to them, our advice right now, get into your bank, get into your lender right now, start having that discussion.
Yeah.
What options do you have? Start like talking to them fervently, because
Don't wait till the week.
if you wait, you're gonna get what they give you.
Yeah.
So
that's for sure. And if they're not going to give you what you need to survive, then you may well have to take 6 months to sell and downsize.
Right,
That's
right.
the only really other option that you have.
But that gives you the time to be planning and doing, and this is often what puts people into financial harm, is they stick their head in the sand and they'll figure it out later instead of planning. And that's what we're always teaching. Just be planning. If you're thinking and planning and making decisions now, then you're not going to get broadsided and have to make a snap decision. And we all know most of us don't make good snap decisions.
And especially when you have very, very few options with house financing in Canada. You have CMHC and 7 banks and credit unions as well, but they all operate very much on the same formats. There is a little bit. I'm a little bit more of a fan of Caisse Populaire and credit unions, because they tend to have a little bit more educated loans officers, as opposed to what I call glorified tellers, because they just fill in the blanks and send it to Toronto. Toronto says yes or no. And so
the other is a mortgage broker. We've had great success with a mortgage broker, because they are shopping. It's in their best interest, because if they don't seal the deal, they make nothing.
Yeah.
So they're great, and they're going to all of these folks as well. So what's the other option to CHMC?
Genworth. And what's the third one? They just renamed.
Yeah, there's a few. So
but
they all doing the same thing.
Yeah,
Mortgage.
CMHC is kind of in the banks and tied together.
Yeah.
So
it for sure is it's a little bit not controversial, but in the United States they have what do they call that? PMI, private mortgage insurance, and we have CMHC and stuff like that. So,
Yeah.
But existing government is trying to make first home ownership much easier and stuff like that. What they used to do, this would be about 25 years ago, where it's it's like an RSP. You put money into it, and
For the FHSA, yeah,
something like that. Whether that's going to whether you're going to be able to keep up with the home prices or not is ridiculous.
Yeah. Well, this new program they've just put into place, the first home savings account here in Canada. It's good in theory, like a lot of programs when they first put it in, but I mean, their maximum is $40,000
after 5 years, so it's really nothing.
Well, you have $8,000 a year.
$800,000, condo that you have to buy.
Yeah. So if you're throttled at putting $8,000 in per year to a maximum of 40,000, so in 5 years you can get $40,000 put into that. How realistically much interest are you going to get on that?
Yeah, I agree. It's a little bit too little, too late.
Exactly.
I think we'll see the program change, to be honest. One of the things that we suggest to people in our course is to avoid paying that CHMC fee or PMI, as far as Ramsey refers to it as. If you're in the process of purchasing a home, put 20% down. That way you avoid paying that fee. If you are already in a mortgage and you're paying your CHMC fee and you've built equity up, I wish I remembered the number. We just talked about this the other day, but there's a point where you can go to your lender and say, I have established this much equity in my home now. I want CHMC taken off of my mortgage. You don't have to pay it until the life of your mortgage is up. You can go in, but they're not going to do it for you. So you need to do that. And that's one way that you can save some money, right?
That's good. That's good. Okay, I think there's one more topic, and this is probably one of the most controversial, and we talked a little bit about it before, and that is credit cards. Can we live without credit cards in Canada? That's the how do you survive in Canada without the use of credit cards? The younger generation, somewhere between, I think, the 18 and 32 or something like that, 28, 32, uses debit cards much more so than the 35 to 55 plus age. They're all addicted to credit cards. The younger, not so much. I really appreciate that. Gives me a hope for the future, in my opinion, because their mindset is very much get a debt. Wonder, it'd be a good study to find out why they are reacting that way. Some people just say, well, they see their parents in all sorts of credit card debt, so I'm not going to be like my parents. I guess at least parents are good for some things sometimes. but I enjoy hearing stuff like that about the younger generation. But credit cards, trying to get a credit rating without credit cards in Canada to buy a house, very, very difficult. It is we have tended to, in the past, we are more attuned to debit cards and technology than all of the United States. There are some places in the United States very high in tech and stuff like this, but there are also pockets in the United States that are still very, very old school. When my wife and I were driving truck, we were using debit cards. We get down to whatever, Georgia or Louisiana, wherever it was, and they didn't even know what debit cards was. They said, "What's a credit card?" No, it's a debit card. Well, what's a debit card? We don't take that. And so like back then, well, that was good 20 years ago or so. And so Canada was totally okay with debit cards. And there are certain portions of the United States that had no understanding of it. So we do have a little bit more, we're a little bit more attuned with technology in Canada. And I credit that to have as few banks as we do in there. But when it really comes down to it, credit card management is very much a personal choice. Like I think you talk about as well. If I was to advise young people, either they start stacking up huge amounts of cash for the house. Actually, the other stats with the younger generation not using debit cards, they've also, unfortunately, they've given up on home ownership. They don't think that they're going to ever own a house, so they just live not paycheck to paycheck, but at least they don't get into debt. But they've given up on home ownership, and realistically, that's something that has to be addressed. And I have an employee who has a credit card, and if he runs something through there and it's $17.75, at the end of the day, he takes money from his account and he makes that direct payment every time in it. And he does that to build his credit rating and yet not deal with debt. That's one way of doing it. Instead of every day doing a transaction like that, you could do it at the end of the week. I would not suggest it anything longer than a week, because then you're starting to rely on the credit to make you to the next paycheck. And then that's where it starts making going into your mind a little bit. And it's psychological, very much so, in there. What is the money plan? What do you espouse when it comes to credit cards?
Well, to start, and then Bill will tag on this. To start, we educate people on what credit is. Number one, it's a product, and it's being sold to us, and it's being sold as a lifestyle. So, life takes Visa, right? All those taglines and the ads, they make it look sexy, they make it look appealing. One of the things we share with our students is they don't show you the fights about money that happen between spouses. Money fights are the number one cause of divorce in North America. They don't show you the reality of what debt actually does to families. So credit is not good. Now, to operate within Canada, we advise people to
let me tag in
use
right here before you say it wrong. I'm going to back up a little bit, because when we started teaching this course, we kind of had that hard line of no credit cards, and people would say,
and that was because like 80 grand was in credit cards because of, she's pointing at me, but it was us. But we went into debt, and the bank kept allowing us,
right.
I need more money. Okay, here it is. They kept tagging on. I had one credit card in my name that allowed a $80,000 purchase. This is a personal credit card. It's not for business. It was personal, and they allowed it.
So yeah, we started that way, and we've kind of relaxed as we teach it more. But what is interesting is that over those 8 years that we've been teaching it, 7-8 years, the use of debit visas, debit MasterCards within Canada has become far more prevalent. They used to say we could do it, and then they didn't work. So we could, preload a card for those of us that had debit or credit problems and had to cut up our cards due to bankruptcies and whatnot. But just as much as this year, even those debit credit instruments have come out on most of your new bank cards. They now have the MasterCard or the Visa symbol on them, and they actually work like that. So that removes a lot of the need for having a literal Visa or MasterCard to, make online purchases or to use, through your PayPal accounts and stuff. You can now attach them to your regular bank card, which has that symbol, and it actually works. I mean, we used to say that 2 years ago when we started teaching the course, and I'm like, hopefully it works.
It works some places, not others. And for businesses, for those that are operating a home business or on the road, right. It was troublesome. But it is, again, the products have changed. The banks are trying to enable us to have more access to their tools, right. Their products. So one of the things you mentioned, the debit Visa, debit MasterCard. So because we were doing online purchases, we needed something like that. But we didn't qualify because we had gone through the consumer proposal. So we established a debit Visa. And so we had to put, well, actually, what was the proper term?
This is where you go wrong, because
What was the proper term?
It was a secured visa.
Secured Visa.
Yeah.
So we actually had to put our own cash on that tool, on that card, so we could use it as a quote unquote credit card. However, it maxed out at the amount that we had put on it itself. So there's ways around using an actual credit product, and that was one of the ways.
Yeah.
But you're right, it is difficult to maneuver around. However, depending on how passionate, how diligent you are about, if you're on the first few money steps, our counsel is do whatever it takes so that you stop going further into debt. And the first step in that is stop going into debt, right? Stop digging your hole deeper, because you're never going to get out. So, cut up the plastic. And you know what? I know Ramsey's dead set against it. I was at first. I have moved this way. It's great to hear that your employee is doing what he's doing. We shared it earlier, but he's a unicorn. That's rare, because the majority of the population don't do that. They say they're going to do that, and they don't follow through. And that's when they start coming to our course.
Yeah. And I think part of the class teaching about credit and credit cards is what we find is people are emotionally attached to some of those cards. So it's when they resist, and I mean, some people resist physically in the class. You can't take my Visa from me. And it's like, well, okay, we're not trying to take your Visa. But when it comes down to it, they've got these emotional support cards that if they have an emergency, and so it's more of an emergency fund in their head, that they have these little plastic discs. So that's just lack of planning. It has nothing to do with that actual little plastic card. So they just need to learn to plan in case they have that emergency, not just count on it being in their pocket. So then it's another discussion. What is actually going on here? Why is this that important to you if you don't actually use it for credit? So that's always an interesting discussion.
I actually have a credit card. I have a WestJet Air Miles, and Air Miles is a big topic point. The only thing I after all of my investigation, the only thing that I considered to be of any remote value to me was WestJet travel miles. I guess they would do travel dollars or so. All the other stuff had points that associated with things, and those things disappeared and they became worthless and stuff. It's like worse than Canadian Tire money. It was ridiculous. Then it comes down to how much emotional and intellectual effort you're putting into what are you doing? What do you change? I have, like I said, like a WestJet credit card. I put a great deal of transactions through that card for my business. And I mean, we got 3 locations, number of more than that locations, and 35 employees, whatever it is. And so I can do $6,000, $8,000, $10,000 a month through there on a regular basis. If you look at the details on what the Air Miles actually how it contributes. If you buy, if you use it at a restaurant, you get something like 3% back. If you use it at Costco or some other regular place, you get 1% back. So a lot depends on where you're buying it. It multiplies more or less. And so realistically, there is pressure to spend. If you're thinking cognitively about Air Miles, you are motivated to spend things that you otherwise wouldn't spend on. Like we generally don't go out to eat. But if I'm thinking, oh, it's Air Miles, then I would be motivated to do something that I wouldn't otherwise do. And that is the trap of whether it's points or Air Miles or whatever it is. Your spending habits change if you are consciously thinking about some reward somewhere. And that's the real issue. And even then, like I've now got it to the point where my habits are not changed at all because of my credit card at all. I don't everything is all structured so that it's mostly all, how do you say it, auto withdrawal and stuff like this. And the reason I do a credit card is it phenomenally reduces the journal entries in for my business. I mean, instead of doing 50 transactions, now I only have to do one transaction in a month, kind of a thing. I'm not lazy, but I just looking for things to do things easier.
I call it efficient.
Yeah, efficiency there. So I mean, it doesn't change what I'm doing, and so now I look at what I'm gaining in air miles, and then what I'm getting for those air miles or WestJet dollars, and realistically, it takes 2 to 3 years to get a free holiday out of it, and it's never free because it doesn't cover absolutely everything. I can get it at a deal, but I have to weigh the efforts, emotional and psychological effort that I put into it versus the rewards for it. And that is what the rewards that you're getting, because they're WestJet holidays, they're expensive, those suckers. Oh my word. And they're sometimes 2 or 3 times more expensive than other things that are out there. So you have to factor that into, if you had cash for it, the value of it is almost not there anymore. And so realistically, if people have an argument that say, yeah, every 2 years I get a free holiday or whatever, well, what are you actually doing for that? The effort, the emotional, psychological effort, and what are you actually paying for, and what are you not paying for? Are you over purchasing? There's all sorts of different things. You cannot allow a credit card to pressure you into getting something that you otherwise would never get. And that
keep preaching. That's good.
Yeah.
Like I don't like being told what to do by a salesperson, and this little piece of plastic is a salesperson, and in the end it comes down to, I want to be efficient with my money, and I don't want a salesperson to tell me how to spend my money. And it is a trap. It's not nearly as deaf what Ramsey says, but it is definitely got a strong point. Very strong.
Well, the reality is you nailed it on the head. It's a salesperson because it's called marketing. All of those programs, all of those cashback, reward points, air miles, all of those things are marketing tools to get you to use their debt product. That's exactly what they want you to do. So they've done their math, and they know that they come out winning, regardless. I mean, look at the office furniture in their lobby opposed to most people's homes. It's much nicer. So they know what they're doing. We come up against the argument too. Well, I get air miles, I get this, and this is where I say, at what risk? At what risk? Because if that tool is going to cause you to continue to stay in debt or to go into further debt, then that needs to be something that you consider to eliminate, right? For a season. We don't tell people, what you're going through the plan, and that's why we call it the money plan. Without a plan, we fail. So when we have a plan, that tool can't take us off our plan because we're focused. I love Zig Ziglar said, if you aim at nothing, you will hit it every time. Exactly. Right? So we have to be on our plan. We have to not allow the tools that we even allow in our lives. Like if it's a credit card, we must be diligent and not go, oh, I'm going to use this because I get that. No, I'm going to use this to purchase that thing. I've weighed the risk, and I will pay it off tomorrow. I'll pay it off by the end of the week. I like what you said. Don't wait longer than a week. If you're going to use that tool, make it a weekly thing. If it's you know, if you're doing your budget weekly or bi-weekly, but my goodness, don't wait for a month, because if you look at some of the new terms for some of the credit cards, they've changed their payment schedule to be 24 days instead of 28
I think they're
days,
farther back than
right?
that, yeah.
Or
Yeah.
17 days. They screw it up so that you miss the payment and you pay interest.
Yeah, and you know that points thing, the stats are that people, I think it's 30%, don't quote me, but people will weigh the points, the benefits over an interest rate, and that's 30% of people will choose whatever benefit disregarding the interest rate that they're going to pay.
I haven't paid interest for probably a decade, more than a couple of decades or whatever on credit card, more than that, you know, something like that. But even when you don't pay interest on it, there is an emotional toll that it takes on you, because you're thinking about things that you shouldn't be thinking about. It's consuming you. It's like that story with a penny, you know.
Yeah.
You're making way too much thought and effort into something that doesn't bring you any value, and sometimes it brings you worse value if you use an instrument. That's for sure. So that's for sure. There's one other thing about air miles, for instance, and air miles is probably the biggest factor when I deal with clients from an accounting, because they say, "Oh, air miles, air miles, air miles." When it comes to air miles, Canada Revenue Agency says you can use air miles, and that's tax-free money. It's non-taxable. Okay. They changed the rules. Boy, this is a number of years, 5-6 years ago already. And there are, and everybody say, hey, it's not only free money, it's after tax money. So it's not taxable. Prior to that, it was taxable. Mm-hmm. And but where they have changed it is, let's say, for instance, you at Christmas time, you want to give out, you know, a Tim Hortons card to somebody, $10, $20 or so. If it has an actual dollar figure to it, that is currency linked, that is taxable. So if I would buy you a $20 Tim Hortons card, technically speaking, you would have to claim that on your personal income tax if I'm using it as a business write-off. Okay, so there's so a lot of people say, hey, well, air miles. I know a guy, very, very wealthy guy. He has a construction company, and when he does some construction through a local building center, he can have $500,000 worth of material go through that building center, and he pays it on his credit card to get the air miles for it. And this guy is a decamillionaire, okay, very, very wealthy. But that being said, he is not making the right choice, because I know the owners of, or one of the senior VPs at the building center, they went to him and say, listen, we'll give you 1.5% reduction in that if you pay with cash rather than your card, because Absolutely. It costs them 2.5%, right?
Right. Yeah.
And the guy wouldn't do it, and he is out what $7,500, something like that, on $500,000. What is it? Oh boy, I better do this. I should be 500,000 at 1.5% times 0.015. Yeah, $7,500. He is out $7,500 so that he can collect $500,000 worth of air miles. Well, he can fly all over the world and do all whatever stuff like that. He is throwing away huge values of money because he didn't take the discount on it. That's an example of an extremely wealthy person still not thinking through what he's doing.
Right. Or is it almost that form of gamification where I feel like I'm getting something for nothing, I'm beating the system, and
never.
You're not. You can't beat these guys. This is their game. This is, you know, the banks have got it figured out. We're not the ones, you know, pulling it over on them.
For sure. Yeah. So like even a decamillionaire can still make stupid bank or financing decisions. Yeah. That's for sure. Okay. Well, I think we should probably wrap this up a little bit.
I wanted to leave you with one thing before we do. And one of the most important lessons that we teach is in week 1. And we challenge people to think about their why. What's your why?
Mhm.
Because without the why, you're not going to follow through.
And it's just a math game then, right?
Right. It's just moving shells around. But if you've got a why, so for some people, the why, if they're later in life, their why might be, I want to be able to bless my grandchildren. Or a why might be, I want to get out of debt because I'd like to purchase a home. Or, later in life, or from our perspective, I'd like to be out of debt so that we can do missions or send somebody to go and do work across the globe. So without that why, there's no purpose in doing any of this other than just to get out of debt. And then what?
You need something to carry you through the really tough times, because like getting out of debt is terrible. It's really fun and fast to get in, but it's really slow and getting out. That's I agree. Very like whether it's your children, your grandchildren, retirement, whatever it is. And
it may change. It may change as you go through life, but you always have to have that in front of you, because it dictates your choices and the options that you have. Be able to make wise decisions.
Sure. Okay, so when do you have your meetings, and how do you sign up? Where do you sign up? Where do you meet or don't meet? That kind of thing.
Sure. We do 2 courses a year. We strategically do one just before Christmas to save people from doing stupid, going into debt. And we do one right after, roughly February, March, to help those that were stupid. Those 2 times a year we do our course. We've been doing it online, so you can check it out at themoneyplan.ca. That's our website, and that's where you sign up as well. We have been doing it primarily through Zoom. Right now we're doing a hybrid course, so we have some folks with us in Niagara Falls live, and we're also connecting with Canadians across our nation right now on Zoom at the same time. So it's a little bit of a discovery for us, and we're finding some hiccups, but it's been working. I think moving forward, one of the things that we want to do is to get our 6 sessions on video, so that it can be brought into a group, whether it be in a home or a community center or a church, that they can do it as a group. But we really, anytime, but we really want people to be able to do it with others, not just at home on their own, because there's no power in that.
Huge factor.
So that's our winter project, is to get those 6 weeks recorded. Eke out some time somewhere.
So and we've been doing it for free. When we first started this, we were charging a nominal fee of, I think, $50 for a couple or single to come through. And then the pandemic happened. And then we started to see people losing their jobs and being stressed out with finances. And so we've made it our mission right now, for the foreseeable future, that is it. And the sad thing is, when we put a dollar figure on it, people come and they stay. And when you don't put a dollar figure to something, as you're probably aware, people don't find value with it. But we don't want to limit anybody from engaging. And so this is the model at the moment, is just to offer this course for free. And we've had people bless us, which is awesome, because then we can just put it back into like the video production and that kind of thing as well. So that's I hope that usually it's I think February 2024. It will be a Thursday evening, and they usually are from 7 p.m. to 9 p.m. Eastern Standard. We have had an opportunity to do a central time zone as well for an organization out. Where were they? Alberta. Yeah.
And
so we did that. We did a 9 p.m. to 11 p.m. because they brought on a full group. So we'd be willing to work with people to do a custom course too, for their church or community group, or even businesses, to help get the word out.
Awesome. Well, that is great. We'll put all of your particulars up on the video here and the like. Well, man, I tell you, this is a lot longer than what I thought, but boy, I enjoyed every minute of it. It's great.
Indeed, same. It's been a pleasure to meet you, and thanks for the opportunity to share.
All right. Okay.
Great.
Okay. We'll see you.
Thank you. Bye.
Take care, Robert.